The trading floor goes dead silent, and the only sound left is the dull hum of screens flickering red from top to bottom. It is March 2026, and something has broken inside the American economy that nobody on cable news is willing to say out loud. The Federal Reserve just held interest rates frozen at 3.5 to 3.75% for the second consecutive meeting, and the message buried inside that decision is far more terrifying than the decision itself. 92,000 jobs vanished from the American economy in a single month, and the unemployment rate just climbed to 4.4%, which is one of the highest readings since 2021. Oil prices have exploded past $100 a barrel because the United States is now in open military conflict with Iran, and the Strait of Hormuz, the most critical oil choke point on the planet, is under active threat. The Dow Jones Industrial Average plunged nearly 800 points in a single session, and that was just the beginning of the bleeding. Wall Street traders who spent 2 years betting on a soft landing are now quietly repositioning their portfolios for something they never expected, and that something smells a lot like stagflation. If you have a retirement account, a brokerage account, or even a simple savings plan, what I am about to tell you over the next several minutes could be the most important financial information you hear all year. This is not fear-mongering, and this is not clickbait. Every single data point I am about to walk you through is sourced directly from the Bureau of Labor Statistics, the Federal Reserve, and the major investment banks. The goal of this video is simple. I want you to understand exactly what the Federal Reserve just did, why they did it, what it means for your money, and most importantly, what you can actually do about it. So let me take you inside the machine and show you where all the gears are grinding against each other. Let us start with the jobs market, because that is where the cracks appeared first and where the damage is spreading fastest. In January, the economy added 126,000 new jobs, which beat expectations and gave everyone a brief sigh of relief. But then February hit like a freight train, with the economy shedding 92,000 jobs in a single month, and that number was not even close to what economists predicted. Analysts had forecast a modest gain of 50,000 jobs, and instead, they got a loss nearly double that figure in the wrong direction. Healthcare employment, which had been the backbone of job creation for months, suddenly collapsed, driven partly by a massive strike in California, but also by deeper structural cracks underneath. Federal government employment continued to trend downward as spending cuts rippled through agencies. The Bureau of Labor Statistics also revised its historical data, showing that monthly job growth in 2025 averaged only 15,000 new positions per month, which is a microscopic number for a country with roughly 170 million workers. Now, here is where it gets complicated, because the labor market is only half of the equation. The other half is inflation, and inflation is telling a completely different story. The headline Consumer Price Index came in at 2.4% in January, which was the lowest reading in 5 years. And that sounds like great news until you look at core personal consumption expenditures, which is the measure the Federal Reserve actually cares about the most. Core personal consumption expenditures, inflation ticked up from 2.9% to 3.0%, and the next reading expected this Friday could push even higher to 3.1%. That means the underlying price pressures in the economy are moving in the wrong direction, while the job market is simultaneously falling apart. This is the textbook definition of a policy nightmare, because the standard playbook says you cut rates when jobs are weak and you raise rates when inflation is hot. But what do you do when both things are happening at the same time? The answer right now is you freeze, and that is exactly what the Federal Reserve chose to do. But freezing has consequences, because every month the Fed sits on its hands is another month that struggling businesses cannot refinance their debt. Another month that laid-off workers cannot find new jobs. And another month that mortgage rates stay painfully elevated. The minutes from the January meeting reveal something even more disturbing, which is that the Federal Reserve is no longer speaking with one voice. Governors Waller and Moran dissented from the decision to hold rates voting instead for an immediate cut, which used to be extremely rare, but is becoming increasingly common. On the other side of the table, other members openly floated the idea of rate hikes later this year if inflation refuses to come down. Chairman Jerome Powell tried to split the difference, telling reporters that whether the current rate is too high, too low, or neutral is, quote, in the eye of the beholder, which is about as close as a Fed chair will ever come to admitting he does not know what to do next. And Powell himself is now a lame duck because President Trump nominated Kevin Warsh to replace him as Fed chair when his term ends in May. Warsh is a former Fed governor with deep Wall Street ties who has publicly criticized Powell for being too slow to act and has praised the administration for what he calls pro-growth policies. Now layer the Iran situation on top of all of this, and you begin to understand why professional money managers are losing sleep. In early March, the United States and Israel launched military operations against Iran, and the conflict escalated rapidly. Iran responded by threatening to close the Strait of Hormuz, which handles roughly 20% of the world's daily oil supply. Oil prices, which had been hovering around $70 to $80 per barrel, rocketed past $100, and some analysts at Wood Mackenzie warned they could reach $150 or even $200 per barrel if the standoff continues. Average gasoline prices across the country jumped 17% since the conflict began, and that is money coming directly out of consumers' pockets. The International Energy Agency responded by coordinating a massive release of 400 million barrels from strategic reserves across 32 member nations. But even that unprecedented move has only managed to keep prices from spiraling further rather than actually bringing them down. Higher oil prices act like a tax on everything because oil does not just power your car, it powers the trucks that deliver your groceries, the factories that make your goods, and the ships that carry imports across the ocean. Goldman Sachs immediately revised its rate cut forecast, pushing the next expected cut from June all the way back to September, and even that projection came with a heavy dose of uncertainty. Traders in the futures market have taken an even darker view. According to the latest data from the futures market, the only rate cut traders now expect in 2026 is a single quarter-point reduction in December, and after that, the market sees no additional cuts until well into 2027 or even early 2028. Let me put that in plain English for you, because the numbers can get abstract. If you bought a home with a variable rate mortgage expecting rates to drop this year, you are now looking at potentially 18 more months of elevated payments. If you are a small business owner carrying debt, at current rates the refinancing window you are counting on may not open until 2028. If you are holding growth stocks that need cheap money to justify their valuations, the air just got thinner at the top. The bond market is already repricing aggressively, and the yield curve is sending signals that have preceded every major recession in the last 50 years. Real estate markets that were just starting to thaw are freezing again because mortgage rates are not coming down anytime soon. And here is the part that nobody in Washington wants to talk about. There are now two completely opposite forces pulling at the economy, and neither side can win without the other side losing. The doves inside the Fed believe that the inflation from tariffs and oil is temporary, and that artificial intelligence will create what they call structural disinflation by boosting productivity and reducing wage pressures. They point to the 1990s tech boom as a historical precedent when productivity gains allowed the economy to grow rapidly without igniting inflation. The hawks counter that artificial intelligence spending is creating a massive investment bubble in data centers and infrastructure that could overheat the economy in the short term. Vice Chair Barr has even suggested that artificial intelligence could push the neutral interest rate higher than its previous range, meaning the Fed may need to keep rates elevated for longer than anyone expected. Then you have the wild card of the new Fed chair. Kevin Warsh is expected to take over in May, and he has signaled he wants to cut rates aggressively to jumpstart the economy. But he will inherit a central bank that is deeply divided, an inflation rate that is moving in the wrong direction, and a geopolitical crisis that is pumping uncertainty into every single market on the planet. So what does all of this mean for your portfolio, and what should you actually do about it? First, understand that the biggest risk right now is not a crash. The biggest risk is a slow, grinding erosion of value that happens so gradually you do not notice it until it is too late. Stagflation does not announce itself with a dramatic single-day collapse. It creeps in month after month as prices rise and wages stagnate and corporate earnings quietly deteriorate. Second, if your portfolio is heavily concentrated in high-growth technology stocks, you need to seriously evaluate whether those positions can withstand 18 months of elevated interest rates. The companies that thrived in the zero-rate era need cheap capital to fund their growth, and that capital is no longer cheap. Third, consider increasing your exposure to sectors that historically perform well during periods of elevated oil prices and persistent inflation, such as energy commodities and companies with strong pricing power. Fourth, do not panic sell, because every piece of data I just shared with you is already known to the market, and the prices you see today already reflect much of this information. The real danger is not what the market knows today, but what happens next. If the Iran conflict escalates further, if oil pushes to $150, if the February jobs report turns out to be the start of a trend rather than a one-month anomaly, then the current pricing could turn out to be wildly optimistic. The Federal Reserve meets again on March 18th, and while a rate hold is virtually guaranteed, what matters most is the language in the statement and the updated economic projections. Watch for any changes to the dot plot which shows where individual Fed members expect rates to go over the next 2 years, because that is where the real signal will be hiding. We are living through one of the most complex and consequential economic moments in recent American history, where a war in the Middle East, a fracturing labor market, a stubborn inflation problem, and a leadership transition at the most powerful central bank on earth are all colliding at exactly the same time. The decisions you make with your money over the next 90 days could define your financial trajectory for the next decade, and that is not an exaggeration. Stay informed, stay diversified, and whatever you do, stay engaged, because the worst thing you can do right now is look away. History does not reward the passive, and this moment demands your full attention.